Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Hello friends, I am Professor Dr. Himesh Doshi from PD Pandya Commerce College, affiliated with Gujarat University, Ahmedabad. Joint venture accounts. When a separate set of book is not maintained, dear friends, in the previous session we did the practice of how the ledger accounts were prepared in the books of each co-venturer when a separate set of books of account is not maintained in the books of the firm. Discussed which journal entries are passed in the book of co-venturers when an advance is given by one co-venturer to another co-venturer. Discussed how to find the closing stock valuation when the gross profit rate on cost is to be added without considering any expenses. In this session, we will solve some more questions on the same method when a separate set of books of account is not maintained in the firm's books. Discussed how to find the valuation of closing stock considering direct expenses. Let us start with illustration number 6. On 1st January 2024, Anil and Bimal entered into a joint venture with the condition to share profit and losses equally. It was decided that Anil is to be paid a commission at the rate of 10% on sales made by him and Bimal is to be paid a salary of Rs 4,000 per month. Following were the transaction relating to joint venture for the period ended 13th June 2024. Anil gave goods worth Rs 3,08,000 from his own stock and paid Rs 17,500 for freight and insurance. Bimal purchased goods worth Rs 2,80,000 at a 10% trade discount and supplied them to Anil. Bimal drew a bill for 3 months of Rs 2 lakhs on Anil. He accepted the bill. Bimal discounted the bill immediately at a discount of 6% per annum. The discounting charges are to be treated as personal expenses of Bimal. 4. Bimal paid Rs 10,500 for freight and carriage charges. 5. Anil sold some of the goods for Rs 7 lakhs and paid Rs 14,000 as a sales expenses. 6. Remaining unsold goods worth Rs 1,40,000 were taken over by Bimal after adding 20% profit on cost price and he paid Rs 7,000 for carriage outward. 7. On 13 June 2024, the joint venture business was closed and both the co-venturers settled their accounts. To sales account, goods supplied from personal stock Rs 3,08,000. To bank account, freight and insurance paid 17,500. To Bimal's account, purchase Rs 2,80,000 minus 10% trade discount, so 2,52,000. To Bimal's account, freight and carriage 10,500. To bank's account, sales expenses paid Rs 14,000. To Bimal account, carriage outward paid Rs 7,000. To commission account, Rs 70,000, that is on sales. To Bimal's account, salary for 6 months at the rate of Rs 4,000 per month, 24,000. Now come to credit side. By bank account, sales Rs 7 lakhs. By closing stock, stock taken over 1,76,400. Now make total on both sides. So total on credit side is little bit more. So total on credit side Rs 8,76,400. So, difference on debit side 1,73,400. It will be apportioned among two partners. So, to profit and loss account, share in profit rupees 86,700 and to Bimal's account rupees 86,700 shares in profit. So, profit is apportioned among both at the rate of 1:1. Here, it is important to find the value of closing stock at which Bimal taken over. Let us calculate the cost of closing stock. Purchase price of goods rupees 3,08,000 purchased by Anil plus rupees 2,52,000 purchased by Bimal. So, total goods rupees 5,60,000. Add freight and insurance paid by Anil rupees 17,500 plus freight and carriage paid by Bimal rupees 10,500. So, total cost of good purchased rupees 5,88,000. Note: sales expenses and carriage outward will not be added to the cost of goods purchased. Now, let us calculate the cost of closing stock worth rupees 1,40,000. Purchase price cost rupees 5,60,000 and 5,88,000. If closing stock is 1,40,000, how much cost? So, cost of closing stock is equal to 5,88,000 multiplied by 1,40,000 divided by 5,60,000. So, rupees 1,47,000, that is the cost of closing stock. So, closing stock taken over by Bimal at cost plus 20% profit. So, 1,47,000 plus 20% profit is equal to rupees 29,400. Total rupees 1,76,400, that is the valuation of closing stock. Explanation: discounting charges will not be debited to the joint venture accounts, as it is agreed that discounting charges are to be treated as a personal expenses of Bimal. Now, let us see how Bimal's account will appear in the books of Anil. Bimal's account, debit side. To Bimal's account, closing stock taken over by Bimal rupees 1,76,400. To Bimal, bills payable account, bills accepted rupees 2 lakhs. Now, come to credit side. By joint venture account, purchases made by Bimal rupees 2,52,000. By joint venture account, freight and carriage paid by Bimal rupees 10,500. By joint venture account, carriage outward paid by Bimal rupees 7,000. By joint venture account, salary payable to Bimal rupees 24,000. By joint venture account, profit share payable to Bimal rupees 86,700. So, total on credit side 3,80,200. There is a difference on debit side rupees 3,800 to bank account, balance amount paid to Bimal rupees 3,800. Now, in the book of Bimal, joint venture account with Anil. Now, come to debit side. To Anil's account, goods supplied by Anil 3,08,000. To Anil's account, expenses paid by Anil 17,500. Freight and insurance paid by Anil. To bank account, purchase made rupees 2,52,000. To bank account, freight and carriage paid 10,500. To Anil's account, rupees 14,000 sales expenses paid by Anil. To bank account, carriage outward paid rupees 7,000. To Anil's account, commission payable to Anil at the rate of 10% on sale rupees 70,000. To salary account rupees 24,000 salary receivable. Now, come to credit side. By Anil's account, sales made by Anil rupees 7 lakhs. By purchase account rupees 1,76,400 closing stock taken over. Now, make total on both side, that is 8,76,400. There is a shortage on debit side rupees 1,73,400. This is called net profit. This profit will be apportioned among Anil and Bimal. So, to profit and loss account rupees 86,700 share in profit, and to Anil's account 86,700 share in profit. Now, let us see Anil's account in the book of Bimal. In the book of Bimal, Anil's account. Now, come to debit side. To joint venture account, sales made by Anil rupees 7 lakhs. Now, come to credit side. By joint venture account 3 lakhs 8,000. Goods supplied to Anil. By joint venture account, freight and insurance paid by Anil rupees 17,500. By joint venture account rupees 14,000, sales expenses paid by Anil. By joint venture account 70,000, commission payable to Anil. By joint venture account 86,700, Anil shares in profit. By bills receivable account rupees 2 lakhs, bills accepted by Anil. Now, make total on both sides, that is 7 lakhs. There is a deficit on credit side 3 lakhs 3,800 by bank's account, balance received from Anil. Let us see another illustration number 7. A and B entered into a joint venture for the purchase and sales of material auctioned by the government. A agreed to provide funds for the purchase of materials and B agreed to devote his time. The profit and losses were to be shared equally, subject to a credit of rupees 5,000 to A by way of interest on his capital. A purchased material worth rupees 2 lakhs and draw a bill at the 2 month for rupees 80,000 on B, which was duly accepted by the latter. The bill was discounted at rupees 300. The expenses in connection with the discounting of the bill were to be treated as a charge against the venture. The various expenses relating to the venture were: A paid rupees 4,000 for carriage and rupees 6,000 for brokerage. B paid rupees 2,000 for sales expenses and rupees 400 for sales commission. 80% of the material was sold by B for rupees 3 lakhs. The stock of unsold goods was taken over by both parties equally. By adding a 10% profit on the cost of material, B paid the amount due to A. Prepare joint venture account and B's account in the book of A and A's account in the book of B. The balance amount due to each other was settled in cash. Let us see how the joint venture account will appear in the book of A. In the book of A, joint venture account with B. Now come to debit side. To interest on capital rupees 5,000. To bank account purchase rupees 2 lakhs. To bills receivable discounting charges rupees 300. To bank account carriage rupees 4,000 and brokerage rupees 6,000 is equal to rupees 10,000. B's account sales expenses rupees 2,000, sales commission rupees 400, total 2,400. Now come to credit side. By B's account, sales made by B rupees 3 lakhs. By purchase account, closing stock taken rupees 23,100. By B's account, closing stock taken over by B 23,100. Now make total on both sides 3,46,200. There is a shortage on debit side. Amount is known as a profit, and that is a portion among both the partners A and B in the ratio of 1:1 to profit and loss account. Share in profit rupees 64,250 and to B's account share in profit 64,250. Let us discuss the valuation of closing stock. Out of the total material purchased rupees 2 lakhs, 80% is sold. So, the closing stock is 20% of material is left. Cost of material is equal to purchase price plus carriage plus brokerage is equal to 2 lakhs plus 4,000 plus 6,000 is equal to total rupees 2 lakhs 10,000. Cost of closing stock rupees 2 lakhs 10,000 multiplied by 20% is equal to rupees 42,000. Valuation of closing stock is equal to cost of closing stock plus 10% profit is equal to rupees 42,000 plus 10% rupees 4,200 profit. Total valuation of closing stock rupees 46,200. The closing stock is taken over by both partners equally at rupees 23,100. Now let us see how B's account will appear in the book of A. In the book of A, B's account now come to debit side. To joint venture account, sales made by B rupees 3 lakhs. To joint venture account, closing stock taken by B rupees 23,100. Come to credit side. By joint venture account, expenses paid by B rupees 2,400, sales expenses rupees 2,000, sales commission rupees 400. By joint venture account, profit share of B 64,250. By bills receivable account, bills accepted by B rupees 80,000. Now make total on both sides 3,23,100. There is a difference on credit side. By bank account 1,76,450 balance amount received from B. Now it is asked to prepare A's account in the book of B. Let us see how A's account will appear in the books of B. As we discussed earlier, B will record all transactions done by A in his account in the book of B. A's account. Now come to debit side. To joint venture account, closing stock rupees 23,100. To bills payable account rupees 80,000. Now come to credit side. By joint venture account, interest on capital payable to A rupees 5,000. By joint venture account, purchases made by A rupees 2 lakhs. By joint venture account, discounting charges paid by A rupees 300. By joint venture account 10,000, expenses paid by A, carriage rupees 4,000, brokerage rupees 6,000. By joint venture account, A's share in the profit of joint venture 64,250. Now make total, that is 2,79,550. There is a difference on debit side 1,76,450 to bank account, balance amount paid to A. Now let us see another illustration of the same method. Illustration number 8. Meena and Neha decided to work in a joint venture to underwrite a public issue of shares and share profit and losses equally. They guaranteed the subscription at par of 1 lakh shares of rupees 10 each in United Limited and to pay all expenses up to allotment in consideration of United Limited issuing to them 5,000. Other shares of rupees 10 each fully paid together with a commission at the rate of 5% in cash, which will be taken by Meena and Neha in the ratio of 3:2. Meena paid stamp charges rupees 6,000, advertising charges rupees 2,000 and printing charges rupees 4,000. Neha paid rent of office rupees 9,000, solicitors charges rupees 15,000. The application fell short by 3,000 shares and Neha introduced rupees 30,000 for the purchase of those shares. The guarantee having been fulfilled, United Limited handed over to the venture 5,000 shares and also paid the commission in cash. All their holdings were subsequently sold by the venturer. Neha receiving rupees 26,000 and Meena rupees 40,000. Balance amount was settled. Write up the necessary accounts in the books of Meena, assuming no separate set of books of account is maintained in the book of the firm. Let us discuss how the joint venture account and Neha's account will be prepared in the books of Meena. In the books of Meena, joint venture account. Now come to debit side. To bank's account, expenses paid, stamp charges rupees 6,000 plus advertising rupees 2,000 plus printing charges rupees 4,000 is equal to 12,000. To Neha's account, expenses paid by Neha, rent of office rupees 9,000, solicitors charges rupees 15,000 is equal to 24,000. To Neha's account, paid by Neha to purchase 3,000 shares rupees 30,000. Now come to credit side. By bank's account rupees 30,000 commission received. By Neha's account, commission received rupees 20,000. By bank account, sales of share rupees 40,000. By Neha's account, shares sold by Neha 26,000. Now make total on both sides 1,16,000. There is a shortage on debit side rupees 50,000, that is known as net profit, and that profit will apportion among Neha. So, to Neha, that is to joint venture account, share in profit 25,000, and to Neha's account, share in profit rupees 25,000. Let us see how Neha's account will appear in the book of Meena. In the books of Meena, Neha's account, come to debit side, to joint venture account, commission rupees 20,000, commission received by Neha. To joint venture account, shares sold by Neha rupees 26,000. Now come to credit side. By joint venture account, expenses paid by Neha rupees 24,000, that is rent of office rupees 9,000, solicitors charges rupees 15,000. By joint venture account, paid by Neha to purchase these 3,000 shares rupees 30,000. To joint venture account, Neha's shares in profit rupees 25,000. Now make total on both sides, that is 79,000. There is a shortage on debit side. To bank account, balance amount rupees 33,000. I hope you understood all these three illustrations we discussed. Let us conclude the session. In this session, we solved some more questions on the same method when a separate set of books of account is not maintained in the books of the firm. Discussed how to find the valuation of closing stock considering direct expenses. In the next session, we will discuss what is the memorandum joint venture account is and how it is prepared. We will also solve more questions of the same method when a separate set of books is not prepared in the book of the firm. Thank you all.